Good Wednesday morning, Market Chameleons. Everyone joining for the first time, thanks for coming by and checking out the Market Chameleon pre-market short. Before we get started, please take a look at the share disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. Sorry about that. Market Chameleon does not make any recommendations for particular securities or derivative instruments. And this show is for informational purposes only. I guess the big thing also is if you are searching for investment advice, please reach out to a licensed professional. With that, D, you ready to get going?
Yep. Good morning, everyone. And let me share my screen here. If you're joining us for the first time, just a quick note, Will and we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, data, or the analytics. If you have a question, type it into the live chat on YouTube. Will's watching it. He'll alert me, let me know, and we'll get to those questions. And to give you guys a couple minutes to put those questions in, we're going to start out taking a look at our pre-market report to see what type of insights we could get on the pre-market trading, and then we will move on to our questions. So let's start out here, pre-market report, and up top, you will notice this calendar view and some summary statistics of the pre-market trading for those historical dates. And the idea there is to quickly eyeball and compare today's activity to the most recent history and to spot maybe something unusual or a trend. Let's review today's activity, which is September 4th over here. And we could see that we have 297 stocks trading higher in the pre-market, 451 stocks trading lower. We have 129 million shares trading on up volume, 95 million on down volume, and we have $923 million worth of stock trading higher, $3.3 billion worth of stock trading lower. So from that perspective, it looks like the pre-market trading so far has a bearish bias. Let's look at it from a couple more perspectives, and then we'll move on to our questions. So I'm going to slide down the page. And as we do that, you'll see this more granular view of the pre-market trading. We now see stock symbols with price changes and volume in the pre-market. We also have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners, and looking at the count, 43 stocks made it onto our biggest percentage gainers list, 111 on our largest decliners. So from that perspective, it also appears that the trading in pre-market has a negative bias. Now, to make it onto this list, we set thresholds because stocks in a pre-market could have very low volume and low liquidity. If it meets our thresholds, it could make it onto this list, and that will include small cap stocks, could include other securities like ETFs. It could be a leveraged ETF or even an inverse ETF, which moves in the opposite direction of the underlying. Closed-end fund, unit, you name it, whatever is listed on the major U.S. exchange can make it on there. So to narrow down this list further, we could use our filters above. Over here, the first filter is in my watch list, and you will see this filter in other places on the website where we have reports and you want to screen those reports. And that allows you to screen out and filter this report by the stocks that you saved in your own unique watch list. So if you created a watch list, like my favorite tech stocks, and you have those 10 stocks that you track, you can use this filter to screen this particular report using your saved watch list. We're going to use this in ETF filter in our example, and it's a similar concept. And when you click on it, you'll see this drop-down menu with different ETFs. We're going to select this first one, SPY. And when we do that, you see that the list below now got filtered by stocks that are holdings in the SPY ETF. So the SPY is the S&P 500. And the idea there is, well, if we had a watch list of S&P 500 companies, we just use this to filter them out. And now we narrowed down the group of stocks we're analyzing to S&P 500 companies. And now we see two of those stocks made it onto our biggest percentage gainers list. 13 made it onto our biggest decliners list. So that also indicates a slightly negative or bearish bias in the pre-market trading activity. We looked at a couple different perspectives as well, and we gave it a couple minutes. So I think I'll take questions now if you have them. Will you're on mute?
Sorry about that. I was having a little bit of a sneezing attack. We didn't have any questions pop up this morning, but I think yesterday we had a MW asked about looking maybe at a seasonality for SPY.
Okay.
I don't know if that's something you could do.
Yeah.
Before you do that, can I share my screen real quick?
Yep.
Right. Share the screen real quick. All right, I'm stopping the share, D. You can take over the screen when you want.
Okay. So let me share my screen here. And I think the question was to take a look at the seasonality of SPY, which is the S&P 500 ETF. And there are different ways to do that. We have different tools to analyze the seasonality. I'll show you one of them. So right now we're on the SPY page, and on the left-hand side, you get these different items to select from on the menu. Let's go to Tools, and under Tools, you see Seasonality. So let's click on that first. And what this does is, I'm gonna close this menu just to expand the screen. It creates a predetermined seasonality table. So it goes back, I think, like 10 years. Okay. And this seasonality is based on monthly performance. Okay, so that's what it is, just looking at, the calendar month of January, calendar month of February, calendar month. So you could see here, these are the calendar months. Up top, these are the years to the left-hand side, and in each box, you have the corresponding performance. So in 2021, SPY lost 1% for the month of January. So you can see that for the month of January, we have listed over here. Same thing for February, and so on. So now we have this particular table that looks at seasonality by the calendar month, going back to 2014. And then if we slide down, we get these summary statistics for that calendar month. Now, when we look at seasonality, just, before we go over the statistics, is, one thing is we want to, if we look at the data, we want to see if the data itself indicates that there's potential seasonality effects on this, particular security. Now, when we look at data, you can just by chance get a seasonality, indication. It could have just by chance, you could have lots of up months in one particular month, and you'd still need to research maybe what is the reason behind it. Why do I think there is a seasonality effect? So even though that the data might indicate that there is a seasonality effect, it could just be by chance. So keep that in mind, and you'd really want to come up with what is the underlying reason that we see this? So for example, we might see a seasonality effect on uh, rents on shore houses, right? And the rents go up in the summer months. Well, that might that seasonality effect might make sense because that's where people desire, the summer months are when people desire to rent the most. And winter months, the demand is not as high. Or airplane tickets, during the holidays, airplane tickets are higher because that's when people want to travel more, demand goes up than other instances. So when we look at the data, the data it's an indicator that there might be some seasonality there, but we still would need to kind of research what's the underlying reason, right, behind it. So we have to always keep that in mind when we do the analysis. So in stocks, maybe there is a reason, maybe one particular month, maybe people give bonuses and they raises, or they need to uh, contribute to their SEP IRA. And maybe there's more demand to buy stock. Maybe there's other months that there's less demand to buy stock. So whatever it is, you'd still have to start doing that analysis, digging further. So having said that, let's take a look at the summary statistics for a particular month, and now we're in September, right? So we just started September, it's September 4th. So we already had, one day of trading, right, yesterday, and then today will be this because we had a holiday. We're close, so we had like one day of full trading. So this reflects so far what September was like in 2024, but this will change between now and the end of September, right? Because the stock could still move around. So this could still change. This is just up to now. But the previous years, okay, now we know what it did month of September. So these are all the data points. So you could see red means it was down, that's the percentage. Green means it was up, that's the percentage move. So we have ups, we have some downs. So let's take a look in general how September looked like historically, and then we could compare it to other months to see if there's like a significant difference, deviated significantly. So one thing, and it's noticeable, is that if we took the average of all the returns for the calendar month of September, right, we averaged them out, we got a negative 2.6%. And this is using so far the 2.1% in September. So that sticks out because if we compare it to the other calendar months, right, most of them were green, up. We do have one down here, but this one, out of all the calendar months in the last, 10 years, from that perspective, had the worst performing months on average. The worst performing calendar month on average was September. That does, stick out a little bit. And that's different if we compared it to the other 11 months on this table. So that's the average, but the average could get pulled down because you have like one really bad month. Okay, so you could have plus 1%, plus 1%, plus 1%, and then one month it was down like 20%. Well, that will bring everything down. So let's look at the frequency of the down months versus up months in September, and then look at and compare those to the other months. So we could see here that out of all our observations, all these observations, we do get a lot of reds. So what are the percentage of the observations positive versus negative? So we see here that 27% of these observations, 27.3% of these observations, the month of September was positive. There's a gain. Now, 72.7%, the month of September had a negative return, lost value. So that too points to that there's on average negative return, and that the frequency, historically, the frequency of negative returns exceeded the frequency of positive returns, by, looks like a significant amount. And let's compare that to the other months. And if we look at it, I'm just scanning, eyeballing it, 72% sticks out. I don't see actually anything above. Well, here's a 54%. There's one more above 50%, the month of January. So that kind of makes it stick out as well, that maybe there is some kind of seasonality impact on the market in the month of September. We'll have to go find the reason why. Is it people coming back from Labor Day, the holidays, or whatever? Is the summer months tend to overprice, whatever it is, but there's some indication from the data that there might be a seasonality impact in the month of September that weighs, on the market. So let's also look at it from a couple more perspectives. If we slide down here, what about the absolute returns? Is there noticeable more volatility? Does it move, even though it's down, is there a lot of volatility in the month of September? And to do that, we could use different formulas, or there are different ways to analyze volatility. You can use open, high, low, close, all these. But in this particular analysis, we look at the total return for the month of September. How did from the start to the end, right? We look at the percentage move, and we take the average of the percentage moves. So we convert all these moves to positive moves and take the average, because we want to see how much did the stock move in either direction on average away from where it started to where it ended, right? So if it started at one price and ended at the same price, well, it might have had a volatility in between, but for that month, it was unchanged. Or did it move far away? Did it start at one price and then move up or down 10% away from that price? So how much did it move on average? So here we see that the absolute return is 3.1%. And just scanning with our eyes and comparing it to the other months, this doesn't look particularly high or out of range. I'm seeing even the next month, you got 4.4, 4.2%, then we had, 2.4, 2.9%. So it's within like the high-low range of the other months. So it doesn't look particularly more volatile if we just measured it from the start to finish. What about looking at it instead of just the averages, the max move versus min move in the month of September? So here we see that the biggest move we had for the month of September in our data set was 9.6%. So over here, this is it. You could see in 2022, the SPY lost 9.6%. if we measured it from the start to the month. So that is a pretty big move. You're talking about almost a 10% move. So that is a pretty big move, but let's compare it to max moves of the other months. So it's still within range. I see here's a 10.9%, right? In November, we've got a 12.7% move in April, which was like to the upside, 13% move. And then we had like some small, so it falls within even that extreme move. If we take it from that point of view, it still falls within range. I can't even say it's on the. I'm not sure if it's even on the upper side because I see, a couple above 10%. 1, 2, 3. So it was down more often, but the volatility didn't seem crazy, at least in September relative to the other months. And this is the min move, so we see that there was even an unchanged right over here. It looks like in 2018 for the month of September, it barely budged, finished near where it started. So let's look at it from another perspective. When we have the averages, we're talking about the average could get skewed lower because of an outlier, right? Because when you take an average of something, you could have observations with small numbers, and then you have one observation with a very big number that skews the average one way, right? But you could have a bunch of like very small changes, and then you get this really big change, and the average moves up. So what if we took the data set, here's in September, and we sorted it from highs to lowest, and then we went right into the middle and said, well, what's the number where half of the observations are above this number and half are below this number? So that's what this is, the median return. So negative 2.1%. So it does show that there's a little bit of a skew, but that it did tend to be more negative, right? Because you have a negative 2.1%. That's the 50th percentile. So that also indicates maybe that there is something going on in the month of September that the market tends to be weaker than the other months. So what about the best move to the upside? Right, let's compare that. What is the best move to the upside? And over here it says up 1.5%. That's over here. There are two times up 1.5%, up 1.5%, 2017 and 2019. So let's compare that to the other months. And here, that also sticks out, right? So we got to the upside, up 1.5% in the last 10 years. But the other months have significantly higher. We got 7%, 8.5%, even the next low one's 5.1%. So I don't know what's up with that one. 1.5% seems like, that it was capped much lower. Maybe there is some weight there on the stock market, because if we took the ranges, this particular one seems to the upside. Okay, here's a 4.3%. There's another, but that still seems far away from, the other ranges on the other months. What about the worst to the downside? So to the downside, the worst month in our observation was down 9.6%. So that's this one over here. In 2022, market was down 9.6%. We talked about it. And how does that compare to the other months? Well, It's a little bit on the high range, but we had, down 13% over here, so March 2020, which was a particularly bad because I think that's where like really COVID uh had an impact on the market. I think we had to shut down the economy basically, to figure out what's going on.
Literally
So
shut down the economy.
I think we had to shut it down. So
Would we ever do that again?
it's possible, right? No, nobody thought it
You,
would happen.
you got to model that again. It's amazing to me. I mean, sorry to hit off, of course, but it's
Yeah,
amazing. I mean, as in trading, you have to watch what's happened in the past, how you
yeah,
predict the future. But
yeah,
like, it's amazing to me, all these new restaurants opening up. To me, they were the front line of the businesses that were devastated because whoever bought a restaurant and thought the government could just shut it down and like some
yeah,
states, they were down for over a year, right?
yeah,
Other states, they were pulling liquor license if they were trying to have people in their bar. I mean, there were so many things that you never even envisioned.
yeah,
Yet now, 3 years later, people are still investing in restaurants.
yeah,
So it's interesting.
yeah.
It really is.
So yeah, but it shows you, it's possible, right? It happened, right? It happened. And if it happened once, it could happen again, right? There's a chance that whatever, unforeseen event, it could still, there's a possibility. But even if we took this unusual event out of there, I still see a 9.3%. So even to the downside, it's on the high end, but not the most extreme. And even on the high end, we've seen some other months there. So just from that, we're almost at 9:30, so I'm going to stop here. But from this perspective, if we looked at the calendar month of September and just looked at the data without, explanations, we'd still need to explain why this might be happening. But the data suggests that the calendar month of September tended to be weaker relative to all the other calendar months. And we looked at it from a couple of different angles. We looked at it from the the average return of all the observations, the frequency of the down versus up moves, the median return, the best and worst uh, um performances. So there's some indication there that maybe something in September uh tends to make that particular month weaker on a seasonal basis than all the other months when we compare them.
Yeah, one thing we didn't even mention was that it is the month where where everyone has been away for basically 2 months, right? On and off. And, you know,
Right.
some percent of the workforce in every industry is off at least one, maybe 2 full weeks over the
Yep.
course of, and you're getting back, everyone's getting back to their job, including people who participate in the money business. And it's another thing to have on your
Yep.
radar for sure.
Yeah, exactly. So, all right. Well, everyone, thank you for joining. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.
Yeah, special thanks for MW is on for the question. Also, D, I forgot to mention tomorrow I have an appointment in the morning, so
Okay.
we're not going to be able to do the show tomorrow
Okay.
morning. So it'll be Friday when we're back on live. Great job as always, Dima. Thanks to all the chameleons who tuned in today, and particularly the questions. Always great. All right, everyone, have a great day. Thanks, D.